Yes, thank you, sir. All right. So, to Matt's point, the topic for today's discussion is rolling naked puts. Every morning, you get a tackle today message, a little message and preview of what we got on the schedule that day. This morning, I had rolling naked puts on the mind, and it's a little short message, and so I wanted to talk more about it in today's Jedi Options segment. Let me start with word here. First of all, you got to kind of understand what a naked put is. Basically, we are building a cash flow trade. Instead of buying a stock, we're going to sell typically an out of the money put in hopes that it expires worthless if the stock continues to be neutral to bullish. Rolling the naked put is an adjustment that you might make the trade more offensive. Maybe you made a bunch of money on the existing position and you want to re-up the trade for the next month. So you close your old one and you sell a new one. When you look at the verbiage, rolling, what does that mean? You're just closing one and opening up another one simultaneously. That's all. Nothing more fancy than that. Close the old one, open up a new one. Do that in one order. You are quote unquote rolling. Because the market has been a little bit messy of late, particularly the last 2 days, I wanted to talk about rolling puts kind of defensively. And visually, I think a picture will help here. A picture will help. You can shift the strike price of the put option up or down as you roll, and that's going to influence the potential profit, right? So let's say the stock is right here, and you have, I don't know, it's a $60 stock, and you have a 50 strike put, right? You have a 60 strike put, 50 strike put, and let's say it's April. You originally sold that put for $1 credit. That's your potential profit. Okay. Listen, if the stock goes up, at some point, you're going to take a profit on this guy and maybe sell a put for May. And then market gods, if they smile upon you in May, you'll do the same thing for June and July and August. One of the things, just as a side note, that I really like when you learn about building a trading system around cash flow, like selling naked puts or selling covered calls, is you start to view trading not as just a one-off trade, but as a system. I don't want a one-off trade. I want a system. I want a way of consistently re-upping my bet and re-upping my bet. I want to redeploy my capital again and again and again and again, so that I make money over time, not just once. And because of the way that naked puts work, because it's a strategy that you can re-up every month, it lends itself very well to this idea of consistency, of being systematic, of generating cash flow. So what I wanted to talk about is, let's assume, let me go back here. Let's assume the stock goes down. Okay. And that's not really what we want to happen. We want it to go up. Let's say the stock goes down. And maybe it goes all the way down to 50. Okay. And your put that you sold for $1 credit is now trading for $3. And if you were to close it, we would call that a debit. So you have a loss in this position. If you wanted to, you could roll this put to a different strike price, typically out to a different month. And so if you want it to be a one-off trade, you could just take the loss and move on. It's always an option with any trade. You do a trade, it doesn't work, take the loss and move on. But think about what you miss out on if you close the thing, completely get out, move on to something else. What you lose is the potential to recoup the loss. What you lose is your exposure. See, what I like about selling puts systematically is if you pick an underlying like the S&P, like IWM, like an ETF, sector ETF like XLE, if you pick an underlying that you expect to recover over time, you know the recovery is coming. You just don't know when. And if you lose your exposure, you guarantee you're not there to participate when it does recover. Okay. And so, no, you won't lose any more money because you got out, but you won't make any money either. And so when I have a position on a stock, or more than likely an ETF that's diversified with a history of always recovering, again, I know the recovery is inevitable. The only question is will I be there when it transpires? And so if I have the conviction that recovery is on the horizon, I'm viewing what's going on right now as temporary. And if I can stay in, I'll be there on the recovery. Well, listen, if it's a long stock trade, there is no expiration date. So you're for sure going to be in. With an option, there's an expiration date. You run out of time. This April naked put is going to hit expiration. And so to extend the time frame, right, to maintain the exposure, I'm going to roll the put from April to May. And so I'm going to buy to close. I'm going to buy to close BTC, this April 50 put for $3. And then I'm going to simultaneously sell to open something in May. And, sometimes we stay at the exact same strike. That would be referred to as rolling out. Okay. I say, buy back the April, sell a May 50 put. Okay. If you want to stay at 50, just push it out another month, get another month of time. You could certainly do that. In this case, you'd buy back the April 50 put for $3, and you're going to get more for May because there's more time and it's the same strike. Let's say you get a $4 credit. Well, all right, what's the benefit? Well, again, I maintain my exposure. That's one of the perks. This morning's Tackle Today message was the 3 perks of rolling puts. One of them is you maintain the exposure, which is a good thing if the stock recovers over the extra 30 days you added to the trade, right? You got some skin in the game. The other thing, though, is you got paid a little more money when you did this, okay? We talk about the net cost of rolling. If I pay $3 to close the old one and I get $4 to enter the new one, the net cost is $1 credit. So we'd say I got another $1 of credit when I rolled it out to the next month. Well, imagine that you just kept getting paid credits every time you rolled. You're just increasing the payday every time you do that. And as you increase the payday, you reduce the potential risk. That's the second benefit of rolling the put from 1 month to the next, for a credit at least, is you are reducing the loss. So I'm extending the trade and I'm reducing the potential loss in the position, which honestly makes me feel good because it could keep going against me. And so if I can make an adjustment that reduces the potential future loss, a little easier to make the decision for me, right? Now, sometimes you don't stay at the same strike. You may say, you know what? This stock's at 50. I want a little more breathing room, right? I'm still going to buy back the old one for $3. But looking out to May, I don't know that I want to be at 50. I think I want to lower the strike down further, maybe to 45, right? So I'm going to sell the May 45 put. So what is that when you go down from 50 to 45? Well, I just told you, down, you're rolling down in strike and out in time from April to May. I'm maintaining my exposure, okay? But in this case, I'm lowering the bar for where the stock needs to be above to make my money. That's going to increase my probability here. So if I view it as more important to have a better likelihood of success going out to the next month, I may lower that strike a little bit to give me a little more breathing room. And the trade-off is, if you got $4 for the 50 put, you're not going to get $4 for the 45 put. Maybe you get $2. Okay. And so in this case, it didn't get able to roll for a credit. Actually cost me a little bit of money, paying $3 and receiving $2. My net cost was $1 debit. And you might say, oh, that's terrible. Well, but look what I got for it, right? Yeah, I got a little less money, but maybe that put that I bought back, that April 50 put, maybe it was an at the money put when I did it, and it had a 50 delta. And I replaced it with a new out of the money put that only had a 30 delta. Well, that improves my probability from 50% to 70%. That costs something. Listen, every time you make a decision where you improve your probability, usually the amount of money you're going to make goes down a little bit. And so there's this entire area of understanding cash flow where you start to better grasp the pros and cons, the trade-offs of rolling out to the same strike or down in price. But just conceptually, the things I want you to take away from this are A, naked puts are a fascinating way to try to cash flow systematically. B, if you're going to do that month to month to month, you're going to have to roll. You're going to have to close the current month and open up a new one, and then close that and open up a new one. And as you do that again and again and again and again, you will start to realize the benefits of maintaining exposure to an asset where the declines are temporary and that it recovers. And then you get to tweak it a little bit month to month. You get to decide if you want to stay at the same strike, you want to roll for a credit, get a nice additional payday for the next month, or is it more important for you to lower the strike, have a little bit better probability? We all have to deal with the balance of how much money I can make and what's the likelihood of getting it. And as you shift one, you shift the other. And this is the fun part, I think, of trading, is you get to be very precise and nuanced in the way that you adjust trades month to month. But final point, this is a technique you're going to use all the time. You'll use it with covered calls as well. Any cash flow trade, managing it from month to month to month, you're going to use the roll technique. Hopefully that gives you a pretty good idea of what it's all about.